Hello and welcome everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Thursday, March 3rd, 2022, and I'm pre-recording this Trading Places Live for a bit later this morning. Futures have been relatively flat and calm overnight, kind of moving a little bit back and forth between up and down, a little bifurcation. Currently, we see the Dow Jones futures up 8 points. The S&P 500 is relatively flat. NASDAQ's down 23. So really not too much change. And we've got the S&P 500 right at that critical 20-day moving average. Is it going to roll over? Is it going to break back up above? I think obviously there's some key stocks, component stocks within the S&P 500 that will probably dictate that. And that's something we'll be looking at in just a bit. But overall, market's been kind of going sideways a little bit more here of late last few days after a big sell-off, big rally, and now the market's really looking for direction. But we're going to get into the S&P and look at all that in just a couple minutes. Let me go through the agenda with you for today. So we'll start off, as we always do, with daily market recap, get into talking technically, take a look at ChartLists. It's one of the I think it's one of the best features at StockCharts because not only can you do your charting, but you can organize your charting into ChartLists. And so I always like to feature the chart list here, StockCharts, because I think it's one of the most powerful features. Then we'll get into earnings spotlight and wrap up the show with the 3 you must see. Before we get into any of that, let me take you over to earningsbeats.com. For those of you who are new, simply go over to earningsbeats.com and you can scroll down. We've got a free newsletter. Our Earnings Beats Digest simply needs your name and email address. That's it. Completely free. So no credit card required. You can unsubscribe at any time. Just name and email address, hit that subscribe button. You can see it comes out 3 times a week, Mondays, Wednesdays, and Fridays. Try to get it out about an hour before the market opens. So normally around the 8:30 a.m. Time on the East Coast. But it's a great way to get to know some of the things that we look at, just the earnings. Relative strength is really big. You hear me talk about that on the show quite a bit. And relative strength, not just versus the benchmark, but also relative strength, just different areas of the market. Intermarket relationships, I think, are extremely important in evaluating the overall market. But I go through all of those things and much, much more. So make sure you sign up for that Earnings Beats Digest free newsletter. All right. Moving on to the market recap, daily market recap for Wednesday. Dow Jones Industrial Average up 600 points. I swear, I feel like I'm just flip-flopping. The day before was down 600. Yesterday up 600. But that's the market we're in right now. And you can see that churning that I'm talking about. Big drop down, big rally, and then just this sideways action here over the past few days. But anyway, Dow up 600, S&P up 80, NASDAQ up 219. Mid caps up 70, small caps up 35 on a percentage basis. Mid caps and small caps were your leaders. We are still in the downtrend on all of these indices, but mid caps maybe doing a little bit better, and small caps best yet, getting back to the highs that we saw back in the middle part of February. You can see right here, trying to get through the 50-day, trying to get through those highs. That's a pretty big level, but when you look across at all the other indices, we're not back to those mid-February highs yet. So definitely there's some rotation you can see taking place, excuse me, in the small cap and mid cap area. AD lines starting to strengthen again there. AD lines have remained pretty strong on the Dow, S&P, and NASDAQ. So that I really do think that's a bullish sign for further down the road. I think that all the selling that's taking place, even these swift moves to the downside, I think are being accumulated by the big firms on Wall Street. So eventually, I'm seeing the market go higher. The only question I have short term is, do we go down for maybe one more leg, maybe 2, between March, maybe into April. I think if we're going to go down, my guess is that we do it now, because this is when we're going to get some awful inflation news coming up next Thursday, by the way. Next Thursday, you'll be getting the February CPI data. It's not going to be good. The headline numbers are not going to be good. And then also when you strip out the food and energy, I suspect we're going to see some pretty high numbers again. So just be prepared, be ready for that. Are we hesitating before another leg down? Has the market already built it all in? Are we ready to take off? Well, that's a really good question, to be honest. My guess is that we have one more leg down. That would be my best guess. And I wouldn't label that 100%. I would maybe say 60-40, 65-35. Again, my long-term slant is bullish. So I don't believe that this is going to be anything that's going to last a long time. I think this is a cyclical bear market. And you might say, well, it's not a bear market yet. The S&P hasn't gone down 20%. Yeah, blah, blah, blah. Look everywhere in the market. I mean, most areas of the market went down 20% before the last bounce. The S&P has not. The NASDAQ, I think, got close, didn't quite make it. But the big reason is there's a handful of stocks, large cap growth names that held those indices up. For the most part, we have seen 20% declines on many of our sub indexes. Among the sectors on Wednesday, we saw financials bouncing back. Of course, 10-year Treasury yield had a big day. We'll look at that in just a second. But that was driving financials higher. Energy, of course, crude oil prices shooting up every day. I mean, today up another $1.50, $2. It was up more than that overnight. But right now, I think that's about where we are. But energy just following crude oil prices higher. Materials continuing to downtrend, but up more than 2% yesterday. So trying to break this downtrend line. Technology, same thing, in a downtrend, confirmed downtrend, lower lows, lower highs. But we are in a nice little rally short term. We're up more than 2% yesterday. Trying to get through that 20-day, which is at 155.36. We finished yesterday at 154.26, coming off the lows down the low 140s. So we've made our way all the way back up to the 20. The question is, can we get through? And there's also a channel that you can see on not just the technology area, but you can draw channel lines on the NASDAQ and on the S&P 500. So we got a little bit more work to do, not only get through the 20-day, but also get through the channel resistance. And it's a little bit above the 20-day in most cases. Industrials also had a nice day here, up more than 2%. This one did actually break back up above the 20-day. So we've got energy, which obviously is the leader. The others we're looking at here are below the 20, except industrials yesterday did make that move back up above the 20. Would have liked to have seen a little bit more volume. I think we still got a lot of work to do, but look maybe now for that 102.50 to 103 area. That along with the 50-day could be a potential problem area for the XLI. All right, 10-year Treasury yield. First of all, later this morning, we've got initial jobless claims coming out. Last week, 232,000. Expectation for this week, same thing, 232,000. Q4 productivity, this is the second estimate. The first estimate last month was 6.7%. And the second estimate due out this morning, also 6.7%. February PMI composite, the estimate there is 56. January factory orders. Well, first of all, December, we saw a decline of 0.4%. January, we're actually looking for that to bounce back, a rise of 0.5%. But this is a in the rear view mirror kind of report. We're talking about back in January. It's now March. February ISM services index, 60.9 is the estimate. That's a little higher than the January number, which came in at 59.9. So we're looking for a little bit of a move to the upside there. Looking at the 10-year Treasury yield, big move up. Like I talked about just a couple minutes ago, financials having a big day yesterday. And the big reason was we saw the 10-year Treasury yield make a big move up. So after dropping from 2% down under 170 in literally just 2 days, that's a massive move in 2 days for the 10-year Treasury yield. Actually, what we could do here is I'm going to pull up a rate of change, and we can just see. Sometimes I like to see, okay, well, historically, what is this move? What is this like? Well, this is a daily chart. So if you put in 2 for the rate of change, it's going to give us the 2-day rate of change. It'll be a very choppy back and forth kind of a thing, but let's see what the high's been. I'm going to do it there, and then we'll just move it up so it's right underneath the price chart. And so here is the 1-year chart of the 10-year Treasury yield. And that 2-day move to the downside right there was the biggest 2-day decline on the 10-year Treasury yield in the entire year, last 52 weeks. So that was a really massive decline over the last couple of days. And this is just since, Russia invaded Ukraine. So all of a sudden, it's almost like the bond market is saying, this is the final straw. We're going to have a recession. That's what this signal tells me. I mean, to have that kind of a decline. But we rally back today. It's like the bond market's as volatile almost as the stock market, maybe a little more so lately. But I would be watching now the range. You got a triple bottom in here at 170, double top previously at 170. So I would certainly think 170 is a pretty big level to watch to the downside. A breakdown below that, I think, would be pointing more and more towards a recession. To the upside, you got what, 205, somewhere 204, 205 as your resistance area. So that's the range that I would be looking at. It's going to be very interesting to see what the 10-year Treasury yield does here over the next week and what folks do in the bond market as we approach that next inflation report. Again, February CPI is due out next Thursday at 8:30 in the morning Eastern time. So how we trade up to that level in both the stock and the bond market, I think is going to be interesting. And then what happens after that? Is that the culprit for the next move to the downside? Could be. We'll see. All right, talking technically, S&P 500, just going to go back over this chart, shown it many times, but anybody who's new to the show, I was looking at a topping head and shoulder pattern, left shoulder. Then we come down the left side of the neckline, the head, right side of the neckline, right shoulder. I think it's pretty symmetrical, except for maybe this little double head right here. But I think left shoulder, right shoulder, pretty close, neckline, almost identical. And then we had the breakdown. Everything was perfect for this breakdown and for the bears, except the volume on this breakdown. Normally we see a big spike in volume on a breakdown. I mean, you're losing major support. So you would think there'd be a ton of sellers, a lot of stops. Really wasn't that many. I mean, it was still, volume was still heavy compared to the rest of the year. But when we look at 2022, this volume was light to moderate. I would even say it was on the light side. And then the volume picked up on the recovery. So that's a little bit of a head scratcher from the bearish side. I mean, even if you're bearish and you think this market's going down, you should at least take note that, hey, this isn't playing out quite like this pattern is supposed to play out. And a break back up above the 20-day, I've seen plenty of false breakdowns where you go back up and then take out, looks like you've reversed, and then you hit the 20-day and then you fail. So instead of failing at the neckline, you fail at the 20-day and go down. Well, we're right up at the 20-day. We're getting close to this this channel. So if you're not really familiar with channels, let me just show you what I'm talking about here. So if I take this high right here and just kind of draw that line right there and then drag it in. I tend to mark candle bodies when I can. I'll use the tails as well. And then you just drag this same line down, and you can, if you do this from this low, notice the low on that false breakdown of the neckline right here, went down and touched that. So then I just take that and I just drag it. So it's something right about in here is where this channel resides. So if you're watching the 20-day, obviously we're right there. But if you're watching this channel, we got maybe a little bit more room, maybe to this reaction high. So, you know, outside, let's call it 44.75, 44.80. To the upside, that would be another 100 points on the S&P. That would give you your channel test. If you start getting above that, now you've ruined or negated the head and shoulder pattern. You will have taken out the 20-day and then take out the channel resistance. That certainly is starting to paint a little bit of a different picture than a downtrend. So no matter how bearish you are, you have to at least begin to recognize that, hey, maybe we bottomed. And I do think there's a chance that we bottomed. I still believe more than 50-50 that we go lower one more time. But when I see the AD lines doing what they're doing, and then I see this reaction, the head and shoulders not breaking down the way it's supposed to and recovering, maybe we bottomed. But from a short-term perspective or intermediate-term perspective, the one thing that still keeps me a little bit on the bearish side is the overall sentiment that we are still in that 1-year moving average of the equity-only put-call ratio that's going higher. We're still in an uptrend there, and we really do need to reset. I think for the market to really launch, I think the market goes higher later this year, but to really get a rally you can trust, I'd like to see more weakness here over the next month or two and reset the sentiment, and in particular that 1-year average of the equity-only put-call ratio. Anyway, so there's your S&P 500 update. Now, if you're looking for that breakout above the 20-day, you can just go to these stocks that I'm going to show you right now. I think I looked at this yesterday, but a lot of these component stocks. These are stocks that are heavily weighted in the S&P 500 and in the NASDAQ 100. So if you're trading the spider, the SPY, or you're trading the Qs, the QQQ, here are the stocks that I think you really need to focus on from a technical perspective, because the SPY and the QQQ are not going to go higher or lower unless these stocks that I'm about to show you do the same thing, or the majority of them act in the same way. I'd keep a particular eye on the 20-day moving average. So here's Apple. It's definitely rolling over. We had the high here. We came down, put in a low, lower high, lower low. So we're set up in this downtrend, but we did go back and test the breakout area around 157. We tested it there. We had a false breakdown there and rallied back. So maybe that's it. Well, one kind of confirming signal would be to see Apple begin to trade back up above its 20-day. By the way, look at the AD line. Yeah, we're going down and we're well off the high, but the AD line is up near its 52-week high. If you know how the AD line works, it's basically you take the volume and then where you finish during the day relative to that day's candle is the multiplier. So like this day right here, when you had this big recovery, even though we only finished up a couple of bucks, that heavy volume is multiplied by 100% because you finished right on the high. And that's why you're seeing this big jump right here in the AD. And then look at the next 2 days. We finished almost on the highs. So most of this volume here over these 3 days goes higher. That's what's driving these AD lines to the upside. So even though from here to here, we only went up about $4 or $5, which really wasn't much considering we lost 22 from 182 or 183 down to 160. So net, we only went up about $5. But because the volume was heavier and we were finishing on the highs, that's what sends that AD line up. It also gives you a sense of how the market is, or in this case, how Apple was trading in the afternoon. I find it really important to know whether a stock is being bought in the afternoon or sold in the afternoon. When stocks are being bought in the afternoon, to me, that's a short-term bullish sign. That doesn't mean the potential cyclical bear market's over. I mean, you're not going to take 3 days action and write that off, especially when the chart still looks like it does. We're still below the 20-day, the 20 days below the 50-day. But this is a secondary indicator that is showing bullish tendencies here. So, or bullish characteristics. So here, if we get a breakout above the 20, especially above that 50-day, break this channel to the downside, the AD line is kind of supporting that. So got to watch these key resistance levels. Anyway, that's Apple. Microsoft actually finished above its 20-day. Two of the stocks I show you will have finished above the 20-day. Now, it's done it before in this downtrend and then goes right back down. So we'll see if it does it again. But this is 2 of the last 3 days now that we've seen Microsoft break above the 20. The bad news, if you're looking at volume, is that the volume on the moves above the 20 haven't been that great. So maybe we roll back over here. But that's Microsoft. Amazon, we trade just below the 20-day. We did get above it once here, got up to the 50, rolled back over. Amazon really not showing the same AD characteristics and hasn't been as the others. You can see the AD line on Amazon, not very good. So price action getting above the 20 would be one thing, but then we also need some support showing some accumulation on this AD line. Tesla, like Microsoft, Tesla actually battled its way back and got above its 20-day yesterday on the close. Barely, but it is above. 879 and change versus 876 is the 20-day. But look at Tesla making a move back up on its AD line, getting close to a breakout. I'm a big fan of Tesla. I think if you look at the short term, yeah, it's in a downtrend, no doubt about it. But if you stretch this out to a weekly chart on Tesla, I mean, all we did was just went in and put a hammer on the 50-week moving average. It doesn't look bad on a long-term chart. And if you notice the last time we got stretched with the PPO, and then we went through a period of consolidation for a little while, a little ABC correction, went right down to that 50, and then we took back off again. Here we make a big move. PPO gets a little stretched. ABC, we're right back to the 50, and now we're putting in a false breakdown. Obviously, if we break back down again on Tesla, that would be bad news short term. But right now, it's kind of Tesla looks pretty good to me on this weekly chart. But we get back to the daily chart, and then we do still have problems because we're trading below the 20, which is well, actually just above the 20. But we've been trading below the 20, which has been below the 50. So short term, I think market still has some problems, and Tesla, honestly, even with that slight break of the 20-day, still has some issues as well. NVIDIA going up to that 20, failing, rolling back over, potentially rolling back over. We have to watch that. But again, look at the AD line. We got these lows, equal lows coming across here, but higher lows on the AD, way off the high end price from a few months ago. The AD line pretty close. Not really giving me a sense that there's massive distribution taking place, which is just another thing that points to a cyclical bear market. If in fact we reach that threshold of 20%, if you want to consider it a tactical bear market, we have to go down 20%. Google, after that big move up with earnings, pulls back all the way to the 2,500 level, turning back up again. This one, though, the AD line not as strong as some of the others, right at the 20-day. Can we get through? I mean, if you want to know why the S&P 500 is struggling at the 20-day, these are charts to show you why. Facebook or Meta platforms, really not good. This one's been going down. The AD line looks horrible. AD line's been going down since its top right here. Showed a little bit of strength back here before it rolled over. Even while we were holding in this sideways pattern, you can see distribution appeared to be taking place, and then the price action follows to the downside. So overall, this is, I would say this one in Amazon, a little among the weaker. We'll get to PayPal, which is pretty weak as well. Adobe, been in this downtrend for a while. AD line been trending lower. Rally back to the 20-day kind of is the poster child with what we're seeing in many of these charts. But here's PayPal, really weak as well. These are 8 of the highest, or 9 actually, of the highest weighted stocks on the NASDAQ 100 and on the S&P 500. And I mean, you can see PayPal really weak. These stocks have to get better technically for the spider and the QQQ to move higher. For our major indices to really get going, this is the group that was carrying them, most of them, through December. Now you can see Meta platforms, PayPal, Amazon, those were struggling before. But the Teslas, the Apples, the Microsofts, the NVIDIAs, Google, they were all doing really well until December. And now they're getting hit. And unless they can reverse, I think we're going to have problems with the overall market. All right, chart lists. I want to just show you earnings, what you can do with these earnings lists. If you're on our, go back to that first chart or first screen I showed you. You go to our website and you subscribe to the Earnings Beats Digest newsletter. One of the things we provide to anyone on there, it's a free newsletter. We also provide free earnings chart lists. So if you're a member at StockCharts and you also sign up for our free newsletter, you can get this, all the information that we provide on earnings. We hand it to you. You can download so that, for instance, this was all of the earnings that came out after the close on Tuesday or before the open on Wednesday. So when you pull this chart list up, it gives you all the major earnings reactions all in one chart list. These are all the, we got it numbered. All the ones starting with 0 give you Tuesday evening. All the ones starting with 1 give you Wednesday morning. So you can sort it to see how they're doing by afternoon, after hours versus morning, if that's what you want to do. You could also see how they're doing versus scooter. Did the high scooters do well? They appeared to. How about the, whoops, let's do the low scooters. Well, some of the low scooters got hit a little bit more. So scooters give you a little bit of a hint. But then just take a look at the percentages, and then you can pull up the columns to see, which areas they were in, the sectors and the industry groups that produce these nice results. Lots you can do with these chart lists, but that was yesterday. Now, the one we have for today, of course, these are going to show you reactions from yesterday, but they haven't reacted to their earnings yet. They will today. And so these are the companies that you want to be looking at. So by the way, the numbering is in market cap order. So you can look and say, oh, Snowflake, this is the highest market cap stock that reported on Wednesday evening. And so that leads me right into earnings spotlight, which I want to show you. Here's Snow. So Snow, by the way, looking at the chart, AD line has looked pretty good. It's getting hit really hard in pre-market. We're going to see My guess is it's probably going to gap down and then rally. That's what the AD line's been telling me, but they did lower their guidance going forward. And I don't care what you do in your numbers. I mean, you might look at this and say, well, why is Snowflake going down? They were expected to earn 3 cents and they earned 12. They quadrupled what they were expected to earn. Stock's down 20% this morning. So we're talking about $50 or more, which is going to take us down closer to 200, which is maybe close to this May low. Maybe we go down and test this May low. I don't know. But with the AD line as strong as it's been, remember, it's not where you finish relative to yesterday's close. It's where you finish relative to that day's candle. So if you go down and open at 200 and then rally all day and close at 220, all the volume will make this AD line go up. Because who's getting out on the gap down? You can't get out on a gap down. As soon as that news came out, market went down, went much lower. So the only way to get out is to get out, start getting out at 200. If distribution takes place, it's going to take place at 200, not from 260. So I think it's really important to see where this stock goes after it opens. And that'll be something to really watch closely in earnings. But this wasn't the only one that struggled after earnings last night or this morning. Viva, another software company. Of course, Snowflake's in that software space. Viva's been downtrending. AD line has not been nearly as strong. Viva beat 90 cents versus 88 cents. I did not see their guidance, but must not have been great. Stock's down 10% this morning. We got two more companies that are down in double digits this morning from earnings. Burlington Stores. So this is more on the retail side, apparel retailer. And Burlington down 14% pre-market. It's been trying to get through 240 based on pre-market. I don't think that's going to happen today, or if it does, it's going to happen on a massive rally. And the last one is BJ's, also down. This one's down 11% this morning. So BJ's, which had been performing a little bit better, nice AD line, down 10.82%. So it's going to probably be back in the 50s. Does it rally after that? Does it continue to show strong accumulation even after the gap down? My bet is it holds this $57 area, 55 to 57. We'll see. There were a couple of good reports. Let me just give you one of those. PSTG, I believe this is in the computer hardware area. Yeah, it is. This one actually, they beat 36 cents versus 27 cents. Stocks up 8% after hours. So pretty good action on Pure Storage. All right, let's take a look at the three you must see. I'm going to bring up three stocks pretty quick. Ford Motor. I think you got to get through this gap resistance. Here was the gap down on the heavy volume. I think we got to get through what's that number before we can really get going. I think Ford needs to get through 1852. We've been up there and tested a couple of times, haven't been able to get through. And then you've got resistance overhead at 19 as well. But the first number, 1852, got to get through there. Next up is Baker Hughes. Oops, a bit of a typo there. Baker Hughes, you see the breakout there. The PPO is not showing here. There is a slight negative divergence. However, volume pretty strong on that breakout. So I still think Baker Hughes goes higher. That AD line looks pretty good. And then finally, Twitter. Twitter's just been going down for a while. I wanted to show you a long-term monthly chart, though. If you're somewhat intrigued by Twitter, I wouldn't be. I mean, look at the long-term chart. It's gone nowhere in the last, really since this whole bull market began back in 2013. That's when the S&P broke above the double top. Twitter's gone sideways for 8 years, 9 years. I'd be careful with it. Anyway, that's it for me. Listen, everybody have a great day. I'll be back next week, Monday, over at earningsbeats.com for your next Trading Places Live. Have a great rest of your day. Be careful. Still a rough market out there. Happy trading, everybody.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.